All right, so we'll be looking at PAYE and CIT as relates to the tax reforms. So we're looking at reforms and implications for businesses, PAYE and CIT. All right. So the contents in this time around, we try to make it a little bit more illustrative. So we have more practical examples here than we had in the previous paper that we just went through. So we'll look at illustration, personal income tax, the changes that we need to know, what is different now from what is always been, because PAYE is not a new tax. You've always been paying it, but the tax reform has introduced some concepts and technologies that is important we all are pressed on. Then we'll also look at company income taxes and then the changes that the reforms introduce, right? And then we'll look at the illustration on CIT and gains. While we are waiting for the 2 or 3 persons that are probably trying to use the restroom, I want to believe that from what we've done so far, we are thoroughly exhausted VAT, and withholding tax. Yes, I think so. I think we've thoroughly exhausted it. Thoroughly. So everybody is a subject expert on withholding tax and VAT as far as I'm concerned. Right? But if there are still 1 or 2 gray areas, we can take them slowly. I don't want to go too far before they join us. Just giving them another 5 minutes to report. So if there are still gray areas, we can run over them. Otherwise, I'll go to my introduction slowly while we still wait for them to be part of the session. So the tax law, the reform involve a comprehensive review and redrafting of all tax and related legislation. It's a transformative journey aimed at simplifying tax compliance, enhancing clarity, coherence, and effectiveness of our tax law, and also importantly, bringing it to bringing our tax law in line with global realities. It's very important. I don't know why I missed that. So the idea is that when we are talking about tax reforms, part of the reasons why it became expedient that we reform our tax law, because our tax law was no longer in sync with what is happening out there in the world. Countries were using tax to, do a lot of things, expand the economy, redistribute wealth, and raise revenue, right? We all know that tax is not just for revenue purposes alone, have we? We all know. Okay, what does that use? What does that thing we use tax apart from to get revenue for government? I would not like
the consequence that usually happens that is not part of it. Because someone that has means will put like 10 experts in the room and tell them to figure out how to save the money.
How to navigate. That's true. And the poor man doesn't have that leverage.
And you know how many people will leave a lot of money on the table because they just don't understand what's going on. It starts with that. How about this people to start with something and you only output it at the end of the year, leaving all that money?
Nice point. But I still didn't get the first one you said. So I was saying that tax or taxation is majorly to generate revenues for governments. I mean, that's what all of us know in school. So we want to contribute money so that government can have money to finance public goods, infrastructures, and services. But I'm saying that beyond to generate revenue for government, What other things do we use tax for? Taxation. What does economic? Yes, for micro and macroeconomic stabilization. Did we get that part? All of us. Okay now. So what else do we use tax for? Apart from as a fiscal policy. What else do we use tax for? And I know you know. So. What else? We use tax for revenue. Yes, to regulate the economy.
Income distribution.
For the government to identify it like more like, I don't know how to.
But the
It's Poland.
ballers. Somebody use taxes to identify the ballers. That's the new one. That's the new one. But as a sign, it should go. But I don't put it the way you have put it. I was saying
About it.
yes, to redistribute wealth. That money also uses tax to redistribute wealth because our tax system is progressive in nature. So those who earn more pay more, right? Then those who earn less, government can either ask them not to pay at all or to pay. At the end of the day, those who pay more, they use that money to do social services and wealth redistribution and all the rest. Tax is also very important for that purpose. Then that one is said, in as much as it sounds let's say illegal, but there's some merit in it. Because if I am as a leader, I want to know the people that have money in the economy. Let's assume it's a functioning economy. I will look at those people that are higher taxpayers. Okay, these are the people that are able to give problem. You understand? I will look at to call them to size. But that's just on the on the lighter note. I don't think that's part of the intent of taxation. So we mentioned about 4 now, to generate revenue as a fiscal policy to redistribute wealth. It's part of revenue. It's comes under revenue. It also helps to discourage consumption of what is this man that we're waiting for? He came and left again. Okay. So you also don't use tax to discourage the consumption of harmful goods. Like when they did the sugar tax recently, government can also put a lot of tax on tobacco. Recently they say they want to ban sachet. The thing that I really hope to the last week of the common man credit social. Then they want to ban possession of sachet. Government can actually stop talking about it. Me, I just feel like if they have a functioning system, why don't even need to tell people to stop producing it now? Just slam tax on 200% of it. When you look at how much you need to buy a bottle, it's almost the amount you need to buy that sachet. Yes. You go and you reduce to reduce consumption. That's just some of the things we start. To provide the infrastructure, yes, when government will get revenue, they need to provide the infrastructure. I don't know if you just go ahead, that will bring us later. Okay, so in this paper, we shall be looking at some critical changes of the 2025 tax reforms as it relates to individuals and corporate income taxes, which became effective 4 January 2026. So why do we pay tax anyway? Why? Do we really need to even pay tax? Is it compulsory? All right, it is because the Constitution actually makes it mandatory that every citizen should declare their income honestly and to appropriate lawful agencies and pay his or her tax promptly. I'm always very careful. I don't know how I miss this, but that's the way the Constitution couched it. I'm always very careful to be using his for things that you actually get gender neutral words to replace so that it don't look like it's only better to make it how carry our women along. But this one is a good just but this one is but I'm not even looking at people with the feel of that. I'm just saying that you should be doing law. You shouldn't be doing law as if you're only talking to men. I don't actually fancy it. most time I try to correct it. If I see law that is talking to me, I put men or women, so that our women are part of every discourse. It's and only teaching. How we pay taxes. All right, so that's the constitutional basis. So who should pay tax? Every taxable person should pay tax. Taxable person will mean person who carries out economic activity in a place or a person exploiting tangible or intangible property for the purpose of obtaining income therefrom by way of trade or an agency of government acting in that capacity. So taxable persons will include the company, individual or body of individuals, family, communities, corporations, sole trustee, executor, or any other legal arrangement, or any person. Taxable person. Any other legal arrangement apart from the one. So it's important to get that part. For any person who earns income by way of employment or carries out an economic activity by exploiting tangible or intangible property for the purpose of obtaining income therefrom by way of to explain this one earlier. So employment would include any appointment or office, whether public or otherwise, for which remuneration is paid. Trade or business strictly means any activity or venture from which income is generated for whatever scale or period it is carried on, but does not include employment. So trade or business would include enterprises and companies, because they are carrying on activity and income is being generated. Remember, we're explaining difference between small businesses and small company as regards to what the law say the threshold is.
But this business also be legal, they should qualify to be legal business.
For tax purposes, there's also legal business.
It's not really.
But you guys don't, yes, now. You guys do
They ask to declare yourself.
choice to call it. For law enforcement, to force.
Okay, so we'll look at what constitutes our total income. This is very important because we are looking at figure, right? So before now, it's actually not before now. For some of the things that sometimes when I hear Mr. Tawodili will say, okay, now, from now, it's not really like from now, it has always been, most cases it has always been like that. But when he say now, Rosdale will not be paying tax, for instance, I actually found that a little bit inappropriate because it's not really new, all right? They weren't exempted before. So if you say now they are going to be paying tax, it's as if before they were exempted. It's not true. All right. So the same, trying to explain that what the law has done, because before now, many organizations for persons who are in employment, once their payee is being deducted and remitted on their behalf, it is deemed that they don't have any other income sources, and they will be issued their tax clearance certificate based on the returns that was filed by the employer. Are we getting it? But what this reform has done is to place emphasis to say that even if you are in employment, government assumes that you have other sources of income. So government expects that when your employer files your return, before you get your tax clearance certificate, your employer's return is no longer sufficient for you to get your tax clearance certificate. You are now expected to also file your own return. It is your own return now that will trigger your getting your tax clearance certificate, not what your employer filed. Because the idea before now is that I'm a salary earner, so what else do you want? My whole money is with you, so we understand. But what we are now saying is that when your employer files, which they will do and pay, before you get your clearance certificate that you are clear, you as an individual, you still go ahead and file your returns. Okay, and that your return will show your total income for the year. So total income is what we have broken down here. So total income for tax purposes will be the aggregate of the employment income your profit from your side hustle, if that's what you choose to call it, your income from investing activities, profit from any other sources, chargeable gains from disposal of chargeable assets, less income of that individual that is exempted from tax, and franked investment income. This will form your total income that will be accessible to tax. Are we following? All right. Then we now come to what we call chargeable income. Chargeable income is different from your total income. We're not saying the technical, some technicalities.
I wish we visit the less, where we have less of the branch investment and the income exempt from tax, I'm going to visit.
Yes. Yes. You have your total income for tax purposes.
I'm saying like the ones where you have less, so you extend to.
Yes.
Are we going to revisit those ones later?
No. You have any issue with them, just show it.
What is the exempt for individuals that are actual
Income.
of the individual that is exempt? What is the income that?
There are many incomes that are not taxable. Yes, we talked about them. Let me look for a scenario. Okay, there's a. Yes, we talked about them when we were looking at that we used income from maybe real estate investment, right? Real estate investment trust. The income you get from soil is not taxable, right? So that particular income is exempt, so it will not form part of your total income.
Okay, sorry. So repeat.
Yes.
Service.
Real estate investment trust.
Then
Who
investment.
Okay, but we did frank investment income. Even though I was trying to avoid, but I see explain. I said frank investment income are those income from which withholding tax have been deducted from source, right? And that amount that has been deducted is treated as the final tax applicable on that particular income. So you don't pay any of that tax on it again. For example, dividends. All right, dividends. So when you have shares in the company and they pay you dividends, before that dividend gets to you, they remove withholding tax. So because of that, that withholding tax is no longer that income is no longer liable for any other income tax. So it's to be treated and regarded as frank investment income. It's a suffer withholding tax, there's no other tax that will be applicable on it. So for individuals, frank investment income would include dividends, interest in short-term securities, right? It's also frank investment income. Yes. But for companies, frank investment income is only dividend. Any other one is treated as part of your income that you aggregate and apply taxes to.
Income from government.
Income from government board is also not taxable because there's no tax on it.
Then you also made a comment, said income is no longer linked to income tax. So any form of tax is not income tax, maybe.
Come again?
So when you were saying you're using description, you said any
Frank
other,
investment income.
any form, so it's no longer, so as far as it's good tax.
Yes, no longer liable
So
to
any
income tax.
income tax.
Yes.
Like taxes that are not income tax.
Like which other tax?
VAT.
Oh, VAT. It's
So
income.
it's the tax that is not income tax, they say.
Which one?
Whether it's not it's VAT
Dividend is not consumption now. Dividend is an income.
I'm just trying to give you feedback on tax that is not income tax. Because I'm not like nothing is coming tonight. So that's why I said
Tax that is not income tax.
that may because you have a target of income taxes. But there are taxes that are not income taxes.
It's income tax we're actually looking at. It's income tax we're looking at. Not
Because any
personal tax.
one that do not apply.
I hope you get me, not that you are just agreeing so that we can move on.
Yes. So yeah, I agree with you.
All right, so we are looking at income tax majorly. So now we're talking about chargeable income. Chargeable income of an individual is the total income, total income, less eligible deductions. What are eligible deductions? So from the total income, so when Mr. Yede was also speaking, or let me not use it so I don't look like I have anything. Let me just use the general commentary on social media. You will hear someone will tell you that if you earn 800,000 and below in a year, you don't pay tax, right? That's actually not factual. That's not the words of the law, right? The words of the law is where your chargeable income is 800,000 and below. So you know that your chargeable income can be different from your total income. So when the chargeable income is that your total income minus these ones, if you have your total income as say 1.5 million, for instance, and you have eligible deductions of 700,000, right? That means your chargeable income is 800,000. You don't pay tax on it. That's what the law said. Because at that level, the tax band that it falls under is 0%.
Yeah.
For 800,000 and below. So it's not if you earn 800,000. Yes, you can use that to explain to a layman so that they can just get what you are saying. But the reality of it is that what the law is pointing towards is towards your chargeable income, not your total income. Are we together? Awesome. So what constitutes eligible deductions? Your contribution to National Housing Fund is an eligible deduction. Your contribution to NHIS, this money we pay to HMOs, is an eligible deduction. Your employees' contributions under the Pension Reform Act is an eligible deduction. Interest on loans for developing an owner-occupied residential house. All right. Interest on mortgage for owner-occupied residential property is also an eligible deduction. Annuity or premium paid in respect of insurance on
his or her life.
Thank you. You see where I'm pausing on his or her life or the life of his or her spouse. Because the wife can actually pay insurance for you now. You know, so you understand. It's not all the time that it's the man that will pay premium for the woman. All right. Rent relief of 20% of your annual rent pay subject to a maximum of 500,000. So let me just explain rent relief because it's a bit of the controversial. When I say it's controversial, okay, it's a new introduction because before now we had what we call the consolidated relief allowance, right? 20% plus 1% or 20% plus 200,000 of your gross income. But it was taken out with this, and what was introduced was now a rent relief of 20% of your annual rent paid. What this is saying is that if you have rent of say 2 million naira per annum, right? You are given a relief of 20% of that amount as part of your eligible deductions. But if your rent is say 3 million naira in a year, 20% of it will be 600,000. The law is saying that the maximum you can claim as an eligible deduction will be 500,000. You cannot claim more than that. That's what the rent relief is talking about. And then someone would ask, how do you, am I supposed to bring evidence of payment of rent to show that yes, I actually paid this? Because if you're a landlord and you are living in your house, you cannot actually claim this relief. Or your wife, they say, after I'm not the landlord, I'm not paying rent, I'm living with my husband, so I want to go and claim rent relief. When you didn't actually pay any rent, you can't claim it.
I pay rent to me.
No, your wife cannot pay rent to you. You understand? You can't claim it. But so the position is that if you choose to claim it, I mean that's not the essence of this class. Remember, the law provides that the tax authority may request for evidence of the rent that you have paid. So if they now request, when you have evidence to prove that you actually did pay and you will complain because of how much you live in one to the Someone was raising hand. Okay, so we can move on.
Asking about mortgage.
Okay.
If you're paying mortgage, there's no form of.
No, there is. That's an interest on mortgage for developing and the owner of buy house. Interest on mortgage.
So, I'm not aware that virtually everybody are paid on there.
Yes, I'm aware.
Even they are not salary, it's too many.
Yeah, everybody's saying around 100,000 call.
How do you manage this?
There's an organization also, there is an INGO as well. And it has they for every means available to reduce their
Staff.
fee. Yes, fee. And I was telling you outside that I went to do this kind of thing, but after the whole talk, I said, probably you have said the Lord, but what we want to know is there's no we have heard, but tell us. I know that what you people are looking at is on the borderline of tax evasion. That's where people are looking to, right? It's not me that come and give the idea this morning and say that's what tax. You go and sort yourself out. They came with this idea of okay, we have agreed that everybody will just pay 500,000 flats. I said it's fine. The only problem with that is when the tax authority begin to require evidence, you must have to produce it. Right? But the law said
Sorry, that your income now, probably your income is 2.4. Let's average of 200 per month. And you are claiming
500,000.
500. It shows that you also pay rent. Once you bring a question that
And that's what I said now. When they get to that view, they will have to cross it themselves. Because I've done the arithmetic. What is 500,000?
yes,
500,000 is really bringing to the table. It's not really.
that's why I said
It's not really that significant.
It's close to other source of it.
Yes. You get the Lord.
If you get to that level,
Okay. So we move on. We all understand what is chargeable income now be.
Yeah.
Total income minus eligible deductions. We move quickly. We talked about the rent relief. So the other changes that were brought in is in terms of the rates. So before now, the rates hovered around 7% to 24%. But under the so what we have is the PITA rates and the NTA rates, Nigerian Tax Act. So under the PITA rate, that's the way it was. You can see the figures are a bit small, 300, 300, 500, 500, 1.6, 3.2 maxed out. But under the new regime, we now have the first 800,000 at 0%. Remember that our chargeable income that we said this is where the relief is being talked about. That if you earn 800,000, you will not pay tax. But what the law actually said is that on the scale of table, your chargeable income for the first 800,000 is at 0%. All right. So you can earn more than 800,000, but what we are interested in would be your chargeable income, right? So the next 2.2 million will be at 15%, the next 9 million 18, next 13 21, next 25 million 23%. If you aggregate this together, you are going to get 50 million naira. So anything above this 50 million naira will now be at 25%. Okay, and then the relief, consolidated relief of 20% of gross income plus 200,000 for everyone. Rent relief of 20% on paid rent, not more than a threshold of 500,000. Landlords not included. Okay, some of the other changes that came with the new act is that before now, we have what we call capital gain tax, right? So capital gain tax as a tax in itself has been eliminated with the new tax reform. So what happens is that if you have capital gains, there's still capital gains, but what we don't have is capital gain tax. Are you following? You can still have tax capital gains. We'll see some illustrations as to what constitutes capital gains. What we don't have anymore is capital gain tax. I'm repeating it again. So what will now happen is that if you have capital gains or chargeable gains, as we call them, you are going to add that gain to part of your income and apply the rate that the bank, the money falls into, either as individuals or as a corporation. Are we following? So if you're a corporation and the tax law is 30%, so whatever gain you are making, you're going to add it to your income as for that company and then calculate the income and the gain together and apply 30%. If you are an individual, you are going to add that gain together with your other income and apply the rates. Make sense? We'll see illustration. Thank God, I need illustration. But I nobody will not say this theory. So what they're saying is this. Before now, you pay taxes separately, and you pay capital gain tax, income taxes separately, capital gain tax separately. With the new law, your income tax and your capital gains are aggregated, they are not separated anymore. So whatever capital or chargeable gains you have made, you are going to add it to your profits, either as an individual or as a company. So if you add it, the capital gains, then let's say you make profit of 50 million, you have capital gain of 10 million. Your total taxable income for that year is now 60 million. That's what the new provision is saying. Instead of you to calculate 50 million at 30% and calculate that 10 million at 10%, you are going to add the two together and apply 30% for a company. But if it's an individual, you are going to add the two together and come to that tax table and then begin to calculate from 0% to 15% up to 25% as the case may be. Are we following? We'll see when we. But I just want those together. That's the chargeable gain is
Make loss.
yes.
You know,
You will make loss. You will go and reduce that loss from your profit or your income. You add it together. It is the loss you made. Yeah, that's the way it works. Employee filing obligations under the Act. I mentioned this before, that beyond the return that is filed by the employer, individuals are also required to file their returns
Now, on individual basis.
on individual basis. But what the law did not see, before now, 31st of January is employer filing deadline, 30th March is individuals filing deadline. But the deadline for individuals has been eliminated. It's only stated in the law. That's why, but we are assuming that you should file early enough. But ideally, what each state we are supposed to do is to domesticate this act into their own harmonized law. Therein, they can now state that in our state, 28th of February is when you pay your PIT, or April, or March. But because it wasn't stated in the Act, for those of us in the FCT, because we don't have the domesticated law in the FCT yet, so we are still assuming 31st March with the deadline. But the reality of it is that if you don't file by 31st March, there is no penalty for it. No, they say when there's no law, there is no, when there's no law, there's no sin. That's what's going to play out. All right. But me, I'll try and file before 31st March because I don't want issues around my tax.
So most of the time, most people's pay right now is, should I say, the activities is carried out by the company. So when you are paid salary, you will be paying out pay, should be having on the basis. And that company, and now you are required to also yes.
Individually, yes.
So if you're doing that in isolation of each other, which you are supposed to be doing for some data, so they're supposed to be done together. Because it still forms your payroll, forms part of your income.
Yeah.
But by the time the company has done it on your behalf,
Yes.
and then you're supposed to go back to your books and start doing your own computation and all of that, that will balance that out. Because literally you already paid payee, your company has already paid your while paying on salary. So how do you balance that? Are you now going to do a computation here and there to track what the wrong way you're from?
Very simple. Very simple. Did you get what I said? So if the company has already filed, yes, they've already filed and they've already paid on your behalf. and now you are filing again and doing another computation, different from the computation they did initially. What it means is that when you finish your computation, the difference between what you computed and what they have paid on your behalf is the balance you will not be required to pay.
But that's
If
what
it's
I
small,
can handle your activities.
Yes.
The company is only
Pay
doing
for
their
the
own
body.
service.
Fantastic.
Okay,
Okay.
then, Mr. What
Yes,
happens?
sir.
We talk about the salary, right? Salary.
Wow,
If you don't get
I
a.
work for the payee as gas price. And the salary is delayed.
And then the staff needs to file.
And you do not start now. As a company, you need to file your payees as at 10th of the following month. And the salary is delayed maybe 15th of the following month.
Okay, so before now, I'm trying to. I know you are asking hypothetically. These are realistic. Realities are out. Before now, the rule is that you are supposed to file on before the 14th. So if you don't file on the 14th, there's a penalty on it. The penalty used under the Peter was 100 naira per day for every day you delay. Right? I didn't even know until they gave my FCTRS, they one of my clients, what's it called? Letter, right? Penalty for late filing. And what they did was to compute 10% and then 30% of the amount, right? And ask them to come and pay it as penalty for late filing. But the issue was that that is not what the law provided for. Under the new act now, if we now complete, we have left Peter environment. This new act says that penalty for late filing is 50,000 in the first month and 25,000 subsequently. I don't know if it applies to late filing for PAYE purposes. That's why when we talk about this case for domestication, it creates clarity. Like when I was on AIT, I kept talking about Ekiti State and how they have been able to domesticate their own that. When you go through that law, yes, it's so beautiful. You know where you stand. Even as someone who is not a salary earner, you are doing business. They put everything in black and white. You know how much you are expected to pay, when you are expected to pay, and all the rest. But when you are in an environment where the tax law has not yet been fully domesticated, even Lagos, I doubt Lagos has done their domestication, but otherwise it's starting, it should have been in the news. Yeah, they're not. I think as at the last time I checked, 8 states, and we don't want to castigate states, but I think many of them are being sloppy. This law was passed on the 26th of June last year. What does it take to do this? It's not like you are writing it afresh. You are just trying to bring it to your own environment. And you are taking 6 months, you are not done. We are now in implementation phase. People don't even know where we stand. As we speak, we don't know what is the date of filing.
But it has electoral consequences. So I'll sit back after election.
Let's move to
It's like sanction.
okay, so the act also says for persons enjoying certain incentives maintained by the relevant tax authority, such incentive, in addition to the annual tax return, you are supposed to submit incentive return. This applies to both companies and individuals. There's something very important that the law also said, which many people gloss over, that if you are doing tax planning, in order to take advantage of loopholes in the tax law, you are required to disclose it also and inform the tax authorities.
Yeah.
That this is what I'm doing. I am the one that opened these 5 businesses. It's because I don't want to stop. I said consequences, but you require to disclose. When you don't disclose, you have one disclose without
Despite the issues of
so you have to. It's very funny, but that's what the law is saying. So it's incentive, you are enjoying incentive. Please let government know that this is incentive. Maybe the president has given you a waiver that you should not pay tax for some period. Please fill a form and let the whole world know that there's an incentive you are enjoying from the government. Yes.
So after making your monthly payments for pay, so you are still required to draw physical documents at FCCRS?
For now, yes. So they are trying to do this online
They
thing.
have a portal now.
That portal
If
is
you download even the table on the corner, you still need to.
that portal is still undergoing renovation.
In situation whereby you have been paying, even before 10, but you know you.
Five.
Yes. So what happens?
I think they will be a bit lenient on that. It's the money they are looking for. Just pay the money first. If you fire and you not pay the money, that's where the problem is. But if you not actually expect that you pay and fire, then if you pay and delay the filing, I don't think it's an issue for now.
Then for some reasons, you missed that annual.
For a company or for an individual.
For a company, that one that.
Is it or January? But that's not you, that's your company.
The company, no, for the company, you are filing for everybody.
Does it concern you? The company is the one that is concerned for 31st of January. The one that concerns you is supposed to be the 31st of March. It's okay, yeah, of course, you pay penalty for late filing, of course. Why is everybody interested in what do you training? And somebody now said, okay, how much if we how much? You want to know how much? Instead of you to come, it's 100,000 for the first one, the 50,000 for subsequent months. So for a lot of organizations, right? It's not about the money. You understand? It's actually about corporate governance. It's about corporate governance. The fact that you didn't pay any penalty at all. For a lot of INGOs, they could sack the country manager because of something as little as that. So it's not how much, because honestly, I think I'm happy with the way they've increased some of the penalty threshold. Because before now, even me, I do it. I have clients that are giving me job and I do not meet up with the filing. And now I can't give myself how much is the penalty. I'll file it in June. I'll file it in July. I'll file it in August. I will pay the difference. You understand? But I don't want to stress my head. But now, when I look at the amount I'm going to dash government because of you know what? Let me just do 2 or 3 sick tests now and file so that I don't have to pay.
Now, I missed it. So I have to know how much.
Oh, you have already missed it. Well done. But essentially that it's 100,000 in. But I think for now, I expect during this transition period, I expect to see a lot of leniency on the part of government. So some people understand everybody is trying to get into the group of the new law. So let's pull down some aspects of it. That's what I expect. But if they ask you to pay, just smile and pay. Just you invest. So most people are coming from them.
People in intelligence.
Yes.
That where 5 the year, and you are still expected to. So if I don't have any of that, so maybe am I going to do the I will not fight.
You will fight. Your salary, you want your national right, same thing. You fight. So those aspects that I talked about, that you just do dash. You put the same to that with the money you earn, and then you submit.
But I hope they will make this thing I hope they will make this thing online.
Your first question,
Like,
you didn't get it. You didn't get it. Yes, I know you didn't get it. But if you have gotten it, you would have like come again. What he's saying is that if you are a salary earner and your organization has filed and you don't have any other income, so apart from the one that your organization filed, so are you going to file me or you don't need to file at all? All right. So I said you will still file, right? But those spaces for other income, you just be putting dash. So what your organization file will still be the same thing you have filed. You don't need to pay any other thing apart from what you have paid already.
What are the things that brought that on point?
You do have. You know what? Let's finish with I will take it during Q&A so that we don't lose track of where we are. But it's a beautiful question. There are a lot of things that could trigger audit. Huge inflows into your account, lifestyle like you have mentioned, funny documentations and funny filings. There are some you are filing returns and every year You know, me and the FCTRS chairman, we do talk constantly. Why? You see somebody will just buy 30,000. That 30,000 has been consistent for the last 5-6 years. That's how much it is. That's to tell you that something or 10,000 and it's consistent. The people was talking about one time when he said somebody came to file return, once we pass into the office, a lady, so that they will not give her assessment, right? After she had, when she walked out of the office, you see the big car and the driver waiting for her outside. So obviously she was doing psychological yes, you know, like what kind of gift? She has a car gift. She just passed to tax office.
So I Lagos now. So I buy a car, come on.
No, but I don't know people that live in Lagos that file their taxes in Abuja.
They live in Lagos and they buy their taxi.
Okay. I know one or two persons that do that because they said it's easier in Abuja, which I can relate to. You understand? It's easier in Abuja because Lagos, they are
not a very big car. And the route to the person, that was about 68 million. But because the person is on a personal employment.
Yeah, self-employed.
Self-employment. They wrote to him that they want to vote it.
Yeah.
Because of they saw the value of that vehicle.
That's why Lagos State is the best. You know, every time we talk about they are the flagship. They are the ones that they are the models everybody should be looking at that. How are they doing what they are doing? You know, it's so beautiful when you see these kind of things. I understand that it's a burden for the citizens, but they're actually doing what they are supposed to be doing. In Nigeria, he can relate. Somebody will call you and tell you, I want to pay my tax return. How much? How much is tax? Like, no, not how much is your fuel. How much is the tax that I'm going to pay? You are not going to put it. You are asking from before the last one to pay. So that's the situation we have in Nigeria. A lot of non-clients.
Not even on just on people with notable names.
Yeah, big names.
When somebody in Asoko also doing that personal do then go do 2 of them. Actually, it was like doing like 4 or 5 million. Say no at 200K. I'm telling you.
He was paying 100,000 or so. And he was a senator. And he's flaunting cars. So the chairman said, look, he told the senators, you all live in Abuja because you cannot claim residency of any other state while you're in the Senate. He said, no senators should get taxing if they don't pay up to 10 million or so. There was last 2 months or 3 months when they were doing screening of ambassadors. This ambassadorial screening at the National Assembly. Somebody called me, said, sorry, Chairman, we need that sinners. No. I need it tomorrow. Please help us. The woman is in Abuja. She stays in Asoko. He was just giving scanty information. But she said she's not doing anything. And me in my okay, give me the names and everything. I always do KYC, maybe because of my banking background. Before I engage in new client, I must know 1 or 2 things. Basic information about you, except you don't have any online presence. And in this day and time, it's very hard. So when I called someone in I said, one of the said the woman said she has 500,000 naira. She just need the tax clearance. You see, 500 or kind of much people. So I called someone in the tax office. I have a friend, one of the tax controllers. I said, Madam, I need tax clearance and I want it by Thursday. She said, Chairman, is it one of the ambassadors that they are screening? I was like, how did she know? He said, why did you just think to? He said, look, as he's talking to me, 2 of them are sitting in her front. And to also get tax clearance. And our chairman has told them that they should not issue tax clearance to any of the ambassadors that are not ready to pay 5 million naira as tax. I got back to the woman and she now said, the husband said she cannot pay that amount, so that she will go to, I don't want to mention their state, not Nasarawa, they are from the east. That she will go to the east and get the tax clearance certificate. That's what Abuja said we can. And well, that's that. So, but essentially, people don't want to pay taxes unless they come. If that woman was in Lagos, it's not 5 million. It's not 5 million. She will pay nothing less than 20 million because she has money. That she was trying to be smart with it. She went to there, and I think she was screened eventually. She's one of our ambassadors in Nigeria today. But that's what we deal with everything, right? Okay, so let's go back to our the one that concerns us. Emolument of a Nigerian, these are still part of the innovation brought in by the new tax law. Emolument of a Nigerian employment performed for a current country or international organization is not subject to tax in any other country under an agreement or diplomatic arrangement to which Nigeria is party to now be taxed in Nigeria. So if you are working in Nigeria for a foreign organization, and let me just explain this one without reading the book. What before now we used to have what we call DTA, double taxation and arrangement, where in Nigeria have signed engagement with some specific countries that if they tax this person, I will not tax it here. What this rule is saying that irrespective of DTA that we have, any individual, as long as you are not being taxed in that country, you will pay tax in Nigeria. So we don't need to have a DTA arrangement in place. As long as that tax you are not paying, even if it's a foreign diplomat working in Nigeria, and Nigerian government is aware that you are not paying tax in your country, you will pay tax in Nigeria. That's what our law has simply said to remove all this DTA confusion. You will pay tax whichever way. You cannot escape tax from there and come and escape it here again. Yes, sir.
What if you pay tax country that doesn't have the treaty agreements with
Nigeria will do computation and see that amount you pay is what you are supposed to pay. There's a difference you pay the balance. That's if you are resident in Nigeria.
without the treaty?
No, don't. What they know as there's no. I don't even think they mention treaty in this law at all. It's just simple, straightforward. Are you paying there? No, then come and pay here.
And if you pay them, you get it as credit.
Yes, you get tax credit. Due dates for tax return has also been eliminated. PIT return is now annually depending on the accounting date chosen by the individual. See section 13 of NTA. However, due date for PAYE returns remain at 1st July 2027. That's what the law says, but you cannot really choose. I still think that when the state domesticates, they will get the date there.
I'm sorry.
I think the state has a date.
I'm sorry. So it means that you can choose the country where you pay your taxes.
No, you cannot choose. You pay tax when you are resident in it.
Okay, because you're saying if I pay over the already, people charge you taxes.
So if you are working in American embassy, for instance, you're a foreign diplomat. Let's not use America. America is a very controversial country. Let's use Ghana. You are working for Ghana, and the Nigerian government has reason to believe that Ghana is not taxing you, and you are resident in Nigeria, right? You will pay tax, even though you are a diplomat. You pay Nigerian tax in Nigeria.
I understand that. I'm saying that I can choose not to pay
You can't choose.
my taxes.
Okay,
That's the country that has a higher tax rate, and then pay the country that has a lower tax rate. Since they are, if Nigeria has a lower tax rate.
That's true. Assessing that. And
And here I simply saying that if your country does not tax you, it's not choosing.
she's asking it differently. So the question is, if you have two jurisdictions and you choose lesser tax regime in the south and you pay your taxes there, then when you go to the other country, they assess you the higher tax that you were already doing, when you still have to pay the difference.
But the question now, can you actually choose?
No, you can't choose.
You can't choose.
You can't choose. What I yes.
You can choose by.
If your family member is involved. No, the Nigerian system defines residency. If you fall within that
residency, ordinarily, because of your residency, you are supposed to pay tax in Nigeria. But you are not claiming that you are a diplomatic staff. That's why you shouldn't pay tax based on our residency rule. We are saying that no wahala. Since you are a diplomat, you should pay tax in your country. And if you don't have evidence to the extent that you have paid tax in that country, you will be served a notice of assessment in your country.
Let me paint the scenario. Maybe it's not America, maybe it's some other country.
Yeah, that's not this America.
It's local tax rate. Maybe
I think you have a choice in the matter.
no. Okay.
You don't have a choice.
How?
Yes, you can't choose your jurisdiction. You need to the narrative. If you are like
You
that,
have residents that country. It's maybe 10%, Nigeria is 30%. I'm paying my tax.
okay, you are not a diplomat.
I'm not a diplomat, I'm an individual.
Where are you resident?
I'm resident
In a tax service for
Which one?
in country. Countries.
What countries?
Both countries.
Oh, so in Nigeria.
Residency here, and the country allows for dual residency.
Just citizenship.
I mean, dual citizenship rather, and I have maybe my family there, and then
Okay.
I'm resident in Nigeria. Okay, so
Temporary.
Just the normal regular.
yes,
Now want to.
I now choose to pay my taxes where they have maybe 10% tax rate.
No problem.
Nigeria will not charge me.
No. As long as you have paid tax there.
Let me ask. So,
Or Grenada.
Does the pay back to the country where you are going to visit the
Yeah.
So it's.
I mean, so what is not going on here because the other thing I have is that you should be resident you don't necessarily need to be present in the certain place.
What we need to understand is this. Why that's why I didn't want to use America as an example because it's a case study. So people have different bases for paying taxes. In Nigeria, our tax is based on residency rule. That's what we apply. That's why our citizens don't pay taxes when they are not residents in Nigeria. But that is not the case for every other country. Some countries they don't use residency, they use citizenship rule. Once you're a citizen of that, like in the United States, their tax is based on citizenship. As a citizen, you must pay your tax, irrespective of where you are resident. That's why I said every country has their own rules. Sometimes some of these rules can clash. When one country says our rule is that once you're a citizen, maybe say Grenada, is that once you're a citizen of Grenada, you pay tax. But Nigeria says once you're a resident in Nigeria, you pay tax. You are not a Nigerian, but you are a citizen of Grenada. You understand? And you are a resident in Nigeria, you now have two taxes to pay. What the tax happens? I said, what the law says that you must have paid one tax for you to be exempted in Nigeria. That's all. So this, you as long as you have paid one, there's evidence that you have paid tax in that country, right? That's fine for Nigeria. But I don't think the law was talking about individuals. What it was looking at is diplomats. That's what the law was looking at, not individuals. Because if it's an individual, you will pay tax if you are resident in Nigeria. You pay tax, even if you are not, as long as you are not, the people that have immunity are diplomats. And government is able that immunity you have. Because they are supposed to have immunity. Government is able that immunity you have. We have to be sure that even with your immunity, you're actually paying tax. If you don't pay, they will charge you. That's what government is trying to say. It's not about an individual per se. So now say I want to choose this jurisdiction. With the way our tax law is couched, they don't even want you to escape. Anyway, so part of the things that the law also talked about is respect to benefit in kind. Okay, so benefit in kind has always been there as well, but we don't really take it serious in Nigeria. But now it's couched in the law. I hope that we will now begin to take it a bit more serious. So what this benefit in kind is saying is that where your employer pays your rent, right? You are working in an organization and part of the facilities they provide for you is benefits that they pay your rent. But that rent is not included as your income, right? What the law is saying that the 100% of that rent will be added back to your income. It's just brought up as part of your income. Where they provide you with maybe land cruiser, thank you, sir. 5% of that asset value of the value. is going to be treated as benefit in kind. Then they now said, in other cases, that benefit in kind will be 100%. Other cases, some organizations will not only give you a house, they will give you house help, gardener, driver. All those are regarded as benefits in kind, and they are taxable in the hand of the person that is given to. Sometimes they not even went as far as saying that some organizations pay school fees for his children and the spouses of the employer. Even that one too, you have to add it back to the salary. It's always been there, but the law has now put emphasis on it because the whole section is devoted to explaining benefit in kind. So all these politicians that they are giving several cars, I'm waiting for how they are going to calculate this thing. You see convoy, 6 cars, they say it's Senate president or house leader. You have to pay
Assets and jobs.
yeah, sure. That's why you're only taking a percentage of the use of that asset.
100% of rent.
Yes, 100% of rent, yes, sure. It's too much.
They provide accommodation.
It's a lot.
Just
If they provide accommodation, that would fall under the category of 5% use of the asset. So if that asset maybe it's in an Asokoro Moitama and it's those are that goes in billion, they use the market value and charge 5% of it.
What's your salary? This is where the employer already.
Yeah.
And they are not netting off the salary. You understand? Then the other case where they are netting off is pay. For example, like car now, so you guys can say 4 years, you know, maybe it comes out, but they will take it, they can say something, it gets acceptable. The end of cases, it's completely unfair. So it's just like right, 1 year, for as long as in the company and it's never used. Will you still, especially that one, or is there any differentiation in the 2 cases?
There's no differentiation. So as long as the asset is for the organization, you pay 5% of. If at the end of the 4 years they give you the car, the tax is expected to also calculate the value at that end of that 4th year and actually say 100% of it. That's what the law.
Yeah, I did by accounting whatever. I don't know whatever. Comes to 0. I didn't know.
No, that's accounting, not tax. That's accounting. Accounting different from tax. You are depreciating it is now 0. The tax is looking at the market value because that's consistently what you find in tax law, not carrying amount, which is what you are describing now. Oh, after 4 years, the asset are fully depreciated, right? It now 0. So they now give it to the employee as 0. The tax authority will calculate the market value as at the date the asset was given to you. So and then calculate
what we are part of the income of that asset now. So in some cases they will say it's rent, or open sorry, not like employer and employee, even for that period.
Yeah.
But it's only after it's so it's not employer's assets now. Or it's not only employer's assets.
And the 5% will be calculated and adjusted for at the case. But the law says 5%. All right, so if you are not saying the rent,
Yeah,
no, what this benefit guy tries to do is to say that your income as an individual is not just the salary you earn alone. Anything you get by way of that employment is deemed to be a benefit. And well,
What about passage tickets?
tickets to where? For holidays. You pay very well. Very well, sir.
When we expended it, we have evidence of the ticket I purchased.
You said for vacation now. For vacation,
Yes.
not for what we put in. Oh, what are you expecting? Nobody wants to know what you use it for. What they make that you can't be so. You can
time something else.
That's not what it's saying. So what
I'm
what
not aware now. What is exactly happening? The way we draw every safety. That's what I'm explaining here. All right. Okay. So you said then if you are using the property, instead of taking 5% on that asset, they will net all the expenses. Right? If it's the asset of the organization, if it's a motor vehicle, you know you repair, you fuel it, all those maintenance and all the rest. So you will net off then they will take 5% of whatever is left, and then you pay as you add it as part of your income. But for uniforms and work tools that is provided for you 0%.
The bank will not go.
No. It's asset.
It's not you for it's not
asset.
I'm a marketer. And
Then on staff allocation. I've answered the question. I say it's asset, not tool. Let me just so we can leave this page. We still have a long way to go. Asset relocation 0% for staff relocation, and staff meal and vouchers, meals that are provided in the course of work is not deemed to be benefit in kind, because they want you to have food to eat so that you can work and make money for government at the end of the day. So that's as much as benefit in kind. I try to summarize it in this place. It's actually very long, but pictures they say speak 1,000 words. Yes.
So if
The final question of benefit in kind.
If your salary is not up to 5% of the, I mean, it's not
Also, your salary is
5% of the rent.
what now?
is that not what we're saying?
Master 20.
Not match.
Master.
They are matched at 20% of.
Where is it match? Where did it match?
See now.
Master
At
20%
20%
of
of
gross income.
gross income.
Oh, okay. Yes. You are very, very happy now. Yes, this is what they're reading.
Yeah.
It's mass.
But sorry, what's the objective for
The objective is to counter tax avoidance.
Right of us.
It's to counter tax avoidance. Where you run to? That's the idea. Okay, so we'll move. Finally, the administration. We still have administration. So Mrs. Hida Gilmorish receives a monthly gross salary of 3 million from a company. She pays rent 3.5 at GRA where she lives. The company also provides work uniform of 560,000 for use in the work premises. In 2024, she disposed her generator plant she bought for 10 million in 2021 for 6 million. So 21 to 24. That's like 4 years thereabouts. Okay? Or 3. Let's see. Maybe December 20. Okay, I'll see the solution. I can't remember. For 6 million, after refurbishing it with 1.7 million, the generator plant has an annual straight line depreciation of 25% per annum. Her employer deducts and remits the following on her behalf. How will we all follow? Yes, I'm reading fast. It's on the screen. NHF, National Housing for 2.5% of the gross. NHIS 2.5%, pension 8%, life assurance 2%. Calculate her tax per annum based on PITA, and also calculate her tax per annum based on NTA 2025. So calculate under the old rule and also calculate it under the new provisions. That's what this is essentially saying. So what we're testing here is how to aggregate capital, because there's a capital gain scenario we're trying to build here. Yes. Right? Then there is her income. All right. Maybe I should have even added profit from side hustle or something. Okay. But it's fine. This is basically explaining what we are trying to speak to. All right. So the calculation is on the screen. We have the gross emolument, 3 million per month, right? 36 million. That's our salary for the year. Big woman, right? Big woman. Less exemptions. There's a note somewhere. When did I do that competition? Yes, somewhere. The PENCOM 8% ordinarily is expected to apply to basic salary, transport, and housing allowance, right? Okay, but an organization also has the right to apply 8% on the total emolument, okay, which will make it more than the basic housing and transport. If the staff doesn't have a problem with that, that's fine. Also, organization where these things are not even broken down, they just bump everything up. So we took 2.5% of that amount. Then the NHIS is applied on also the basic salary, right? But where it is not given, we can also apply it on the gross. So what we're trying to do is to explain ideally what should work out, but that's what we call or what we're trying to test here. We're just trying to test how capital gains will be brought into the book. Life insurance also is applied on the gross as we have done in this scenario. All right, so we've taken 2.5, 8% like that for her eligible deductions, right? Okay, so we have total yes.
Exemption. Total exemption is 5.4.
Why didn't we bring the rent here? There's a rent of 3.5 now, yes. Why is it not here?
The rent is paid on behalf of
%, plus, it's not 20% plus 200.
Yeah, the rent.
the rent paid by the employers.
She did the
Yeah, well, you paid rent after.
So they pay 500K.
So you don't have 500K,
I think she has answered the question.
this is Peter now.
Thank you. That's the reason. All right. Thank you for noting that. I wanted to be sure that everybody is following. All right. So then you have CRA. Good. So her total eligible deductions 5.4 million. Consolidated relief allowance 6.3 using 20% or 1% plus. So 200,000 plus 20% of the gross income, or 1% of gross income plus 20%, whichever is higher, is what the tax law will take as her relief. So you take the CRA. Everybody is so serious because we are busy. I know that this is how we like because we have not gone the whole slide with figures. All right, so that's where we are. The taxable income arrives at 24,174,000. Then applying the old tax rate. Remember the old tax rate, huh? The first 300,000, the next 300,000, the next 500, the next 500, the next 1.6, and then above 20, the next 20.
20,970,000.
Thank you. So this is the total emolument for this total tax payable for the year. Then this will now give us the monthly tax. Right? It's clear.
Yes, sir.
Mr. Obaya, this will be yes, we have thank you. All right, so that's how we are. Right? It's clear, everybody gets it. If you don't get it, just wave your hand where you are. We'll see. You don't even need to tell you you get it. Awesome.
Let's see the first of the new tax.
Okay, so then we'll go to the capital gain tax. She bought the asset at 10 million naira initial cost. This 6 million was the amount she sold it. Good. Then we depreciate it from 2022, 25%, 23, 25%, 2.5 million. Then the third at 2.5 million. So net book as at 2024, 2.5 million. So we remove 7.5. All right. So that means the asset that was sold for 6 million, the net book in her books is 2.5. Then she spent, don't forget, she spent 1.7 million to refurbish it. Good. That 1.7 million will also have to deduct it. The chargeable gain for the disposal of that generator plant is 1.8 million. So she's going to pay capital gain tax of 10%, which will be 180,000. So she will pay this one separately. It's clear enough?
Yeah.
That's under the old rule.
Standing in law.
Now let's see how it will apply in the new rule now. Based on the Nigerian Tax Act now. She still earns 36 million. As eligible deductions are still constant, but the consolidated relief allowance has disappeared. Right? She's now eligible to 20% of her 3.5 million rent,
500.
subject to a limit of 500,000. So we'll bring the 500,000 here and we deduct it from this. Her total income from employment is now 30,100,000. You now see that gain she made.
1.8, yeah.
You see where it came in here. We add it to the chargeable income to arrive at the total chargeable income.
Yeah.
That is what we are now going to take to the tax branch. So we are not separating them anymore. We are bringing it into the computation of our income tax for the year. Right? So we now apply the new rates. The first 800,000, of course, is 0%. The next 2.2, 15%. The next 9 million, at 18%. 13 million at 21%. And then the balance of 6.9 will be at 23%. They didn't reach the 50 million threshold, which would have been 25%. So the total 6.2, this is for her income. Then this is the total for the year. That's how much she's going to pay as her tax for the year.
487 is per month, right?
Yes.
Compared to Peter, what's the difference?
You know,
I just want to see.
but let me explain something. You know, when government say this new tax is not favorable, that's to the extent that your income doesn't cross 18, 20 million threshold.
Yes.
Once you cross 18, 20 million, you are likely to pay more. So definitely,
And because you are among the
definitely this figure will be more than but if you want to compare, maybe we can compare only the salary portion. Because I left this here just to give us an idea of this salary versus that one. But if we use this one has already inculcated the 1.8 million. So it will be a good measure. So let's say instead of she's now going to be paying 487,750. But before now she was paying 456. So you see that it's
66 because capital is.
no, 456 and 487 is like for like.
That's what I'm saying. That capital gains is not included.
It's not included.
Peter.
It's not also included here, just for class work purpose. I didn't include it here. This one is just to tell us how much you will pay from employment income in loan. So that we can compare this 487 and that 466 just side by side. But this is actually what she's due to pay total at the end of the year.
It's different.
It's not that more. Thank you. You notice it
It's
too.
going to be more if your income is more.
Yes, Madam, last question. Let's see. You don't have it. Don't shout you. Yes, say, but the other is these things won't be nothing. You have not asked the question. So I want to this that you are following. Can we move? Can we move forward? Wait, sorry. We can make progress, Abi. Yes. We are all good. So this is still explaining the computation I just did. So she will pay 414,000 extra as a result of the gain on the disposal of her asset based on the NTA, in addition to the PAYE deductions from her salary. All right. This is saying all what you just putting it in writing.
Did the tax reform touch capital allowance?
Yes. You want us to go there?
If I pay together.
We'll get there. Touch capital allowance. So like I said, all we're trying to do is to look at all the innovations that they brought that wasn't there before, especially that capital data. It's important we test it because the way it was treated before, it was separate, but now we are, combining it together. Yeah, slightly higher.
If you are a loss, so
You have a loss on disposal. Yeah, you bring it in.
bring it to
Yeah, sure.
balance.
Exactly. If the government to ask you to pay tax on the gain, when you now make loss, and you bring your loss too now.
So what
All of us will gonna suffer
minus? So you know
the tax. It's not a minus. Say you don't have tax to pay for that year. So it's problem.
minus.
If I have
Give it some.
We will get to some scenarios that especially
because bank
okay, one government to balance you for the money.
are doing valuation.
Okay.
Okay, so if an asset can have a value,
Okay, after the initial number of before let's suppose say 3 years before now it used to be 4 years written off, but at the 4th year they revalue. Okay, now at the point you want to sell it to the staff,
Yes.
there is a loss because of the evaluation.
Loss. Who is making the loss?
Yeah, because if they are selling it to the staff, they are selling it lower than the values.
So where is that loss going to? The company want to deduct the loss from its profit.
No, see now because of that, because normally if they have made a profit, they will want to pay capital gain. Okay, but it's a loss now because of that initial evaluation. The tax law allow.
You know, it will not be allowed because it was it will be deemed that that transaction was not at arm's length, except you are able to prove that what you did was at arm's length. If you are selling properties to your staff or to yourself or to the directors, it will be deemed to be a related party transaction. So it will be seen as an artificial engagement as far as tax is concerned. So that loss, you will recognize it, but when it comes to tax, they will add it back and tell you that it's not an allowable deduction, except to the extent that you can prove that the amount you sold it was the best you could get in the market.
So third party.
And if it's a third party, that's absolutely understandable to be allowed. But to your staff, knowing that you are selling it below your value, that you did your evaluation yourself, you're not selling the asset less than the valued amount, then something is not adding up somewhere. Fine. Okay, so the chargeable gains that we just talked about, there are some exemptions to it. So it's not all gains that you make as an individual that is chargeable to liable to taxation. One of it, which is the most common one, is the where you this process of disposal of shares. Sorry, disposal process on shares. There should be on shares here. Okay, please. In aggregate, it's less than 150 million in a year, and the gain does not exceed 10 million in that 12 consecutive months. You don't pay any tax on it. Should I come again?
Yeah.
So if you buy shares and then you dispose them off in a year, and the sales proceed total that you sold in that year is no more than 150 million, and also the gain that you made from that proceed does not exceed 10 million naira, means that you will not pay any tax on this 10 million. So if your gain, yes, if your gain, for instance, is now 15 million instead of 10 million that is given as you give, you will pay tax on the extra 5 million and not on the 15 million. Are we good? Yes, so it's a relief that has been dealing. Shares are transferred between an approved borrower and a lender in a regulated security lending transaction, or proceeds of such disposal, notwithstanding the threshold above, are invested within the same year of assessment with the acquisition of shares in the same or other companies, provided that the tax shall accrue proportionately on the proceeds or on the portion of the proceeds which are not invested in the manner stipulated in this subsection. I will explain. So what this one is saying is that if you sell shares and it's above 150 million, let's say you sold 200 million, 250 million naira value of shares, yes, and then the gain, the proceeds from it, you reinvested it in another share, the same company or any other company in Nigeria. That gain you made, you will not pay tax on it. Are we following? So far, the proceeds you reinvested it, there's no tax on it. That's what he's saying. I know there's one small I don't want to put it, that's why I'm not confused the one that I'm arranging inside our head like that. Let's just leave it like that. But that's what it's saying. Then sums derived by way of compensation for any loss of office or employment is also not liable to capital gain tax. It was liable before now. So what this is saying is that you are an employee of an organization, and then the organization sacks the person and say, well, we are sorry, your services are no longer required. Take this 50 million and go home. That's a compensation for the loss of office or employment. That 50 million naira is not liable to tax. Is there no cap? No cap. No cap. Yes, no cap. Don't worry. When we get to cap, I will bring your attention to it. Sums received under a policy of insurance and the risk of any kind of injury or damage or the loss of the possession of assets received in return for forfeiture of rights, insurance premium and refund for injury is also not taxable. Okay, chargeable gain that shall not accrue on the disposal of an interest or the rights under any such policy of assurance contract, still on insurance. Now, coming to the cap that Mr. Akinjayeju, yes, I don't want to spoil the name. Mr. Festus, okay. Sums not exceeding 50,000 naira obtained by way of compensation for damages. See, this one is not loss of office. This one is for damages suffered by an individual or injury suffered by an individual in his profession, including compensation for loss of office, wrong or injury for libel, slander, or enticement. So why is this? Hold on. I'm seeing something under this law now because it's no.
I say that some derived well compensation for loss of office is exempted, but there is a some not exceed 15 of them by way of compensation for loss of office again. So I think it's capped at 50 million. 50 million.
It's not the same thing. I'm coming. There's an issue, so I will get it. Don't worry. There's no cap on compensation for loss of office. But this one is compensation. I need to know how this compensation linked to this loss of office here. But this one is talking about a compensation arrangement for something that has been okay. Could it be that this compensation that we are talking about here is
as a result of injury?
Yeah, as a result of injury, right? That is the compensation that is talking. Or probably you went to court and court has given judgments and say yes, and say this people you were wrongfully, your work was wrongfully terminated. So the court now gives judgment to say pay him so and so amount. That could also be the scenario painted here. But you can go to this
Legal section of this.
yes, that is the word that is, but this one there's no cap. I'm very sure of it. All right. So gains accrued to an individual in respect of disposal of or an interest in a dwelling house or part of a dwelling house, land and other land used for commercial purposes, it may be adjoining the dwelling house up to a maximum of 1 acre. When you sell a house that you are living, or there is a parcel of land adjoining your home and you sell it, it means that you don't pay capital gain. There's no chargeable gain that has aroused from it. The exemption for this one is enjoyed once in a lifetime. It's not like you're going to gather another house and go and sell it again, and then you are now changing houses up and down. So that once you've enjoyed it once in your life, until you come in another life, you cannot enjoy it again. Then this one is saying gain on disposal of an asset, which is a tangible movable property or charter shall not be chargeable to gain as long as it doesn't exceed 5 million naira. So if you have gold, for women that are selling gold, if you sell gold and the disposal amount does not exceed 5 million or 3 times the amount of the annual national minimum wage, whichever is higher, you don't pay, there's no chargeable gain on it. Then motor vehicle that you're using for private, not for profit purpose, when you sell it, your personal car, right? You shall not pay chargeable, there's no chargeable gain. But this one is also subjected to 2 motor vehicles in a year. So you cannot begin to be selling vehicles up and down and telling people that it's your private car. No. You have started car, running business.
No.
When a person disposes by way of gift, an asset acquired by him, also by way of a gift, not being an acquisition on devolution on death, the gains accruing from the disposal shall not be chargeable fees. Any property held in trust for charity and not-for-profit organizations shall not be subject to the provisions of capital gains, provided it is not in connection with trade or business. These ones are very straightforward and clear. I want to move quickly to CIT because our time, honestly, we have run out of time. We shall now look briefly at some of the changes in taxation of businesses as regards income taxes applicable to companies. Companies now, we've done PAYE, we've done earlier. In Nigeria, the NTA stipulates that a small company will be taxed at a rate of 0%. Those the companies that have therefore companies that have 100 million above turnover, the tax will be 30%. It now went further to define small company, which will mean any company with turnover of less than 100 million and assets, fixed assets not exceeding 250 million. So what this means is that you can actually have turnover less than 100 million, but if your fixed asset exceeds 250 million, you will not be categorized as a small company. Are we following? Yeah. And it's also said somewhere that the small company does not include people that are rendering professional services,
including yourself.
Because I wanted to go and change to companies when I now saw that provision. But of course, there are ways around it, just like you mentioned earlier. All right, so also a development levy of 4% is to be charged on accessible profit of companies. Small companies, individuals, and non-resident companies are exempted from the development levy.
30%.
Coming in?
That's over the 30%.
Which one? The development levy. Yes, I was trying to explain this. The development levy is the one that replaces the education tax, the NITDA, the NASENI, police trust fund, all aggregated together, they were all eliminated, right? But now replaced with a single tax of 4% development levy. And it's chargeable on the accessible profit. We're good?
Yeah.
So
this total assets, see cost or debit.
The law did not define, it said the value of the total fixed asset cost. That's why you need implementation guideline. So I'm running now because, like I said, I don't want to come and flash paper in my face. Excess interest. This is also one of the new developments. All these things we're talking about are new developments. I'm not trying to teach CIT from the beginning. I'm just bringing out those ones that are different from what we've known before now. All right. So excess interest means an amount of total interest paid or payable to a connected person in excess of 30% of earnings before interest and tax will be disallowed. So I'm the MD is my wife. I am the husband of the owner of the business. I now give them the loan to run business. And the interest that they are paying me is more than 30% of the earnings before interest and tax and depreciation and amortization. The law is saying that they cannot pay me more than 30%. The highest they can pay to a connected person is 30% of this earning before interest and tax. The balance will be carried forward to another period. This is to discourage the idea of people manipulating who can issuing all manner of loans to themselves. So, but this is in relation to a connected person. Before now, they didn't put it as connected person, but now it's clear that this is speaking only to connected person. Then effective minimum tax rate. This one is talking to a constituent entity of a multinational enterprise, which has aggregate turnover of 750 million euro, or any other company in Nigeria with turnover of 50 billion naira and above in a year, will pay effective tax rate equal to 15%. So you cannot pay less than 50%. This one is a global rule. Nigeria is just domesticating it. What this tries to do is to discourage companies that are doing profit shifting and base erosion. Like people will be moving profit from one jurisdiction to another. They are saying if you like, move it anywhere. If you're a member of this group and you are in Nigeria and your group turnover is more than 750 million euro, the effective tax rate that company in Nigeria will pay will be equal to 15%. Or if you're a Nigerian company and your turnover is 50 billion naira and above, the effective tax rate will be at least 15%. So what exactly is the effective tax rate? I want to define it here. The tax rate produced by dividing the aggregate tax paid by a company for a year of assessment by the profits of that company. So when you look at how much tax did this company pay, this company paid $10 million, for instance. And their profit for the year, being the profit before tax as reported in the audited financial statement, less 5% of depreciation and personnel costs for the year. So government say remove personnel costs from that profit. Divide the amount you paid by whatever is left. If it is less than 15%, government will ask you to pay the balance to make it up to 15%. So in other words, there's what effective minimum tax. So there's a minimum those categories of businesses can pay. Any other business in Nigeria, in fact, what this is even saying that you cannot even make loss. I mean, if you make loss, no, you can make loss. You can make loss. It's where you make profit. Yes, you have to make profit first. And then the tax you now paid should not be less than 15% of that profit, subject to the adjustment for 5% of depreciation and personnel costs for the year. That's what constitutes effective minimum. That is for multinational entities that is part of the multinational entity group. For instance, let's say Google has an office in Nigeria, for instance. Google is a multinational entity that's doing transaction. Then their turnover in Nigeria, when they now registered Google Nigeria Limited, right, to be the Nigerian arm of the global enterprise. Because Google is doing turnover in excess of 750 million euros, they are already under the purview of this minimum tax rule. All right. The above scenario otherwise, minimum tax is eliminated from our tax laws. Now for capital allowance. But in capital allowance, we are still looking at changes to CIT. Okay, there is the removal of initial allowance. Before now we have what we call initial allowance and annual allowance. In fact, there's another allowance that was removed. Investment allowance is also removed. It used to be there. All right. So there's removal of initial allowance and investment allowance on capital expenditure. Company can no longer claim initial allowance in the first year of putting asset to use. This could lead to higher initial tax liabilities and then reduced cash flow. When you start business fresh, there was a basis for that initial allowance. That's when you do initial outlay. You buy heavy equipment, for that first period. So government give you initial allowance and expect you to spread the rest. But the new law, there's no more initial allowance. They just give you a rate, 20%, 25%, and 10%, as the case may be. So whichever one you choose from the first year, you need to apply that rate consistently as your annual allowance. The amendment in section 274 allows businesses with non-taxable income below 10% of total income to fully utilize their capital allowances. Yes. So what this is summarizing here, the law is that if you have you are doing a business, you are using a particular asset. The asset is funding your taxable income and your non-taxable income. For instance, Robert is the one that used to like us to give examples. For instance, if you are doing export business, the income from exports is not taxable. Okay, we'll get there. Nobody agreed with me. So if you are into exports, the income you are making from the export leg of your business is not so is treated as non-taxable income. So you have income, part of it is for export, part of it is for domestic use. You see that export leg, if it's higher than what the law is saying in the act says is that the capital allowance should be proportionate. You should only claim capital allowance on the percentage of the income that is taxable. Okay. You should prorate it to say, okay, this building, we are using it for both the export and also the non-exports. So therefore, the capital allowance we will claim. Government will not give you capital allowance for everything. They will expect you to prorate it. But they are saying here now that if the non-taxable income is less than 10%, don't worry, don't bother to prorate. Just take 100% of your capital allowance. That's what this thing is summarizing. Did you get the logic? Yes. If it is more than this, they expect you to prorate the capital allowance. You can't claim capital allowance for income that you are not generating and then you come and claim it. No. But when you say if it's less than 10%, don't worry, just claim everything. Small companies can now claim full capital allowance without provision, reducing taxable profit and CIT obligation. So that period that your company is existing, and that small company stage, you have capital allowance, but you are not claiming, you are not utilizing it. You are not utilizing it, right? You can take it forward to the period where you begin to utilize the capital allowance to be there for you. All right, that's what this one is essentially trying to say. Sorry, I'm moving very fast now. There's another illustration I wanted us to look at. Where in a year of assessment, more than 25% of the sales of an export processing zone entity arise from sale of goods or services in the custom area, tax shall accrue in Nigeria on the profits of the entity in respect of the total sales. So companies in export processing zone, originally the idea and concept is that whatever they are producing there is for exports. Everything in export processing zone, the original idea is that you export them. That's why you don't pay that. But of recent, companies that are now in export processing zone are now there. They are not paying tax, but they are selling goods in custom territory. They are producing and selling their goods in Nigeria. The law is now saying that if in a year of assessment you sell more than 25% of the goods, that portion of sales in Nigeria will not be liable to tax. If the goods, let's say you produce goods worth over $100 million, $8 billion, because easy for me now, shouting billion billions, $100 million, and then you sell in Nigerian territory 30%, $30 million, and exported $70 million. That $30 million you sold in Nigeria, you will pay tax on that portion. That's what this is saying. But however, it's saying that when the money is sold in Nigeria is less than 25%, you don't need to pay. Don't worry, just carry your wallet and go. However, that waiver will lapse 2027 December 28. 27 December, because effective January 2028, any portion you sold in Nigeria territory, you pay tax on it. But with this transition period, they are telling you, we see what you people are doing, right? It's wrong, but we'll allow you, so far you are not doing more than 25% for now. But once it's effective January 2028, you will need to pay tax on the portion you are selling in Nigeria territory. Then there's a general principle of tax deductibility. Before now, those of us who are doing ICANN, then you say only reasonably, exclusively, and necessarily to qualify as a deduction. But under the new regime, all you need is for you to be wholly and exclusively incurred for the business. You don't need to prove reasonability, and you don't need to prove necessity anymore. Are we together? Okay. Then deduction for research and development. Deduction to be allowed under 1652 of the AT has now been adjusted to 5% of a company's turnover for the year. Before now, it used to be 10% of total profits. So that is a bigger base. So expenses you incur for research will be allowed to the extent of 5% of your turnover, instead of 10% of the profit that used to be the case before now. I hope I'm not moving too fast. I know I'm fast, but it shouldn't be so fast that we are not following. Everybody's quiet.
We are fine.
Are we sure that we are fine? We are sure with the information. No, we are good. Okay, because like I said, I want to get to the illustration. I know we like illustration very well. Minimum tax for resident company, we talked about this earlier. We said we told it that we treated as frank investment income. But whatever the non-resident company is paying must not be less than 5% of the income. Then control foreign company rules. This one is simply trying to explain that there are some companies that are owned by Nigerian companies, but they are not in Nigeria. They are supposed to declare dividends, but for some funny reason, they make profit. For some funny reasons, they did not declare dividend. You know, if they declare dividend, dividend will come to the Nigerian company, and then you pay tax on top of it in Nigeria. But they didn't declare dividend there, so that income does not come to Nigeria. What this CSC rule is saying is that government will compute the profit they have made, calculate the percentage that the Nigerian company has in that company, and bring that money that was not declared as part of the profit for this year, and then you pay tax on it. That's what this current control foreign company rule says. Did we get the logic? You are a Nigerian company. Periscope Nigeria has Periscope UK as a branch. Then Periscope UK made profit for the year. That profit was kept in UK. It wasn't, the dividend was supposed to come to Periscope Nigeria, who is the parent company, right? They did not declare dividend, they just kept the profit to themselves. The tax authority is saying that, and meanwhile, Periscope Nigeria owns 50% of the shares of Periscope UK. So that profit they made and they did not declare the dividend. The CFC rule is saying that the tax authority in Nigeria will take 50% of that profit for the year, add it to the profit of Periscope Nigeria, and ask them to pay the tax to government.
But if it's a fully owned subsidiary, it is expected that that's what is consolidated.
Yes, yes, and you didn't consolidate it. Yes, you pay the profit in and then you pay tax on it. VAT on QC, I think we mentioned this when we were discussing VAT, to say that if you do not pay VAT on certain qualified expenditure, you cannot pay capital allowance on it. That's what is also applicable for companies. Deductions for donation. The total deduction for donation for a company to any year assessment shall not exceed an amount equal to 10% of the profit before the end of the year for that year. Right? Agri plantation industry. There's also one that I'm not seeing here. Okay, no matter. Agri plantation industry, the trade of a company which operates a plantation to which an economic development incentive certificate has been issued shall be deemed to commence on the date when the planting first reach commercial production. So you have an economic development incentives that have been granted to you. Maybe you're in a priority sector and you went into plantation. They said that incentive will not be triggered until the plants have reached commercial production level. Okay? Reporting threshold. This is also important. Every bank, insurance company, and other financial institutions are required by law to disclose new customers. 1, 2, where an individual has cumulative amount of 25 million in a month or more, or a corporate body where it has transaction with a cumulative transaction of amounting to 100 million naira or more in a month. This report is expected to be rendered every 3 months, every quarter, to the Nigerian Revenue Service, to the tax authority. So, before now, it used to be 5 million naira, you disclose to this anti-money laundering. But this new law is now saying 25 million for individuals and 100 million for corporate.
It's cumulative, not one transaction.
No, not total transaction for the month. Once it hits 100 million, they are supposed to report it. Yes.
It's not supposed to be
Because
it's supposed to.
Single transaction, the second one will be okay. So before now, it used to be if you have transaction of 5 billion, that's the good. Yeah. But this new rule is that if you have cumulative transaction, they won't report all the transactions.
No.
For each company.
Or 100 billion for
yes, for company.
Is that 100 million more?
More.
Yes.
I think it's okay.
Because what the senator said, that this figure was not the figure they approved. Yeah, I thought
It's a month. It's not 100 million.
A month. Is it a month?
Is it a month?
a month.
No.
Why do you think this? Which company do you think in Nigeria has 100 million a month?
But also companies that do.
Let me explain. The idea is not for you. Government does not need. How do I explain it now? If they're not using this information for I don't know what you think they're using it for, but I can tell you what I think they are using it for. It's for intelligence gathering. So the idea is that they want to see those companies are doing 100 million above turnover in a month, that they are in the tax net. That's just what government is after. They are in tax net. They're not using it to compute your tax for the year. It's just to see that there's nobody doing transaction at this level that is not captured and paying tax at that level.
And again, it's something they are waiting for. people that would declare themselves as small income, small companies.
And they will also see
You see them when people have done the juju and said it's 100 million. They will come here and
so intelligence now. Maybe I think they are using it to compute their tax for the year. That's an intelligence thing. And they are going to use, they are going to probably adopt a software to match the name of the company. That's what the tax. They won't, it's not like they are going to sit down and be checking each company to see how much they do. It's just to see that they are in the tax rate. So you don't have it, so it's to squeeze everybody to come into the so there's also introduced the economic tax development is
sorry sir, before you know.
economic development tax
is because we have this yearly fight tax authority. Our transactions are based on margin, brokerage. We can do transaction at the billion, and make 100,000, and make 200,000. It's not possible.
Even the brokerage does it.
Allow please give me a example. Maybe 20 kobo.
Let's use reasonable amount.
But no,
Yes, sir.
So the question now is that most times the tax authority want to leave the total volume as a turnover. But maybe our turnover is supposed to be margin, the next margin made.
What's okay? If you use the total volume
No,
as a turnover,
now we go and report 1 billion.
It's not an issue now. If they report 1 billion for you, don't forget the reason why you have paid before is because VAT, they were asking people to come and pay value-added tax on the once it's no longer there, there's nothing. If you declare 100 billion as your turnover, and you declare 99.99 billion as your cost of sales, your margin is still the same thing now. So it doesn't really have any effect. Don't worry, calm down. There's no cause for alarm.
That's right.
All right, so there was also introduced, before now we have what we call pioneer status incentive. So I'm assuming that because I'm moving fast, all of us know what is pioneer status.
Yes.
Not all of us, but most of us shall. Pioneer status has been taken off. It has now been replaced with what we call economic development tax incentive. This incentive, it will give you 5% per annum on the qualifying capital expenditure you have incurred to set up that business, and it is given to what government has classified as priority sector industries or services, right? So, and it's for 5 years. Okay, 5% on your qualifying capital expenditure, it will be given to you for 5 years. After 5 years, it will lapse. Once it lapses, they will give you additional 5 years so that in case we are not able to utilize this credit, it's a 5% credit. So if, for instance, you bought assets worth $100 million to Nigeria and you collected this tax incentive, it means that those assets of $100 million that you bought, 5% of it would be $5 million. It's a tax credit that is already standing for you. So whatever you earn at the end of the year, you first of all remove the credits before you pay balance on the tax. Right? That's what the EDTI is talking about. Then other incentives. Yeah, this is the one I was thinking about.
What you look at that big plantation is discouraging to farmers that until they say it until it reaches commercial, there's a cost there.
Yes. Do you want it to be claimed when I plant a crop that is going to take 7 years to mature, and I have an incentive that is lapsing after 5 years? So would you prefer that the incentive will lapse before my crop even mature for me to start enjoying that?
Okay, the 5 years start
that is what they are saying. That you get it now. Beautiful. So other incentives that we have in the act, we have agri businesses are now exempted from income tax for the first 5 years of business. So those of us who want to go into farming, this is the right time now. 5 years, no tax, just be making your money.
That's 5 years.
Just 5 years.
But you have to file.
Yeah, obligation of filing is compulsory for everybody. All right. So profit of companies engaged in sports activities we also exempted. Dividend, rent, interest, or royalty derived from outside Nigeria and brought into Nigeria through approved channels exempted from tax. Profit of Nigerian company other than companies engaged in upstream, midstream, or downstream in respect of goods exported. Remember, we mentioned this earlier. When you're into export, the profit is exempted. Dividend received from investment in wholly export-oriented businesses exempted. Income from bonds issued by state or the federal government exempted. Income generated by companies engaged in agri business for the first 5 years of business also exempted. Beautiful, right? So we move to the illustration. My time is up. My coordinator is standing on me. During the examination of 20, we have two. We'll take one, we'll read the other one now. During the examination of 2027 returns, Nigerian Revenue Service discovered that the company did not disclose 20 million rental income. So there's a tax audit. They've already filed, right? But because of the audit, they now discovered that there's a 20 million income they earned from rent, they did not disclose it. Then there's a 10 million naira investment interest income. Both the rental and investment income suffered 10% to tax deduction. Suffered it. In a revised computation, compute the development levy and the company income tax, considering that the accessible profit of the company is 50 million naira. Okay? Capital allowance relief is 33 million, and the company has already paid 5.1 million naira as tax. There's a small issue, but maybe somebody will not notice it. Let's move on to so accessible profit 50 million, right? Abi? Yeah. This is what the company declares accessible profit. Then the development area at 4% is on accessible profit, right? Then annual allowance, capital allowance, 33 million. Okay? Then taxable income from business, 50 minus 33, we arrive at 17. Are we following? Then add rental income, they did not add it initially, so we are not adding it back. Add investment interest income, 30 million. So the new total taxable profit is now 47 million.
This rental income and investment income is in net of total or
both suffered 10% withholding tax deduction.
net?
No, it's gross. They are telling you, they have told you the amount they did not disclose. They did not say the amount that hit their account, the total is gross. But they are also telling you that there's a 10% that it has suffered. Good. So we now arrive at new tax rate at 30%. Will be what? 30% of 47 million. Nobody is punching. Somebody punching for us? Okay. So we have 14.1 million. Less the tax that they have already paid. So less withholding tax that they suffered. 10% of 20 million and 10 million. So we now have a standing company tax of 60 million. 6 million. All right. I think this is pretty much straightforward. No question. Okay. Stardust Impresario is the second one. Please, 2 minutes, we are done. Sold shares valued at 100 million for 145 million, made a gain of 45 million, but we invested the whole amount in another shares in the year. Calculate capital gains. See, nobody's talking about capital gains tax. Calculate capital gains. So the disposal amount is 145 million. The cost is 100 million. Capital gain is 45 million. So you will notice that the turnover is 145 million, so it's less than the 150 million threshold. Remember. However, the profit is more than 10. And you're only giving relief up to 10 million naira. So it will now be 45 million minus that 10 million stipulated by law. We'll now have 35 million. So applying tax rate of 30% of 35 million, it will give us the tax component. This is just an extract. Remember, we don't do this in isolation. It will go into the company.
But invested well.
You get that before.
It's true.
Yes, sir. You pay. Ah, and no hold up.
So that's invested it.
Let's assume you know invested. You can spend with money. You are telling me, if you know why you are preparing scenarios and sleep with me, you know, I didn't know. There are actually two. You are done, we are complete. We are completed. In conclusion, so anyway, all of us got that. I mean, it shows that we are actually following for us to notice that this man invest the money. Right. So in conclusion, over the last few years, the Nigerian government has consistently ensured the review of tax and fiscal regulation in the country. You know, we have been doing the Finance Act, at regular intervals. Because this reform offers the most comprehensive overhaul of our tax laws in recent times. They are critical in enhancing social contract nexus between the state and the citizenry. Importantly, to build trust, government should improve communication about how tax revenue fund public services and infrastructure, and also invest in long-term taxpayer education to build a culture of compliance and national development. All right, thank you very much. For those who are not 2:30, right? 2 o'clock. I maybe we won't do too many questions and answers this time, like in the first paper.
Do we have any questions? Or you've asked all your questions? Oh, so please, let's have lunch. We're eating into our lunch time, but
Seriously.
let's have lunch and be back for 10 minutes.
Wow.
We're gonna do
Let's see if we can get back for 3:30, please, and then we'll take the last session for the day. Please, let's quickly grab lunch and be back at 3:30.
That's fine.